The global markets just experienced their worst single-day plunge in months, and most investors completely missed the warning signs. President Trump's sweeping tariffs on America's three largest trading partners have sent Wall Street scrambling, with the S&P 500 already down 5% from its recent highs. Meanwhile, Goldman Sachs analysts are warning this could be just the beginning of a much larger market correction. Even more concerning, the U.S. Economic Policy Uncertainty Index just skyrocketed to 502, its highest level since the pandemic crash of March 2020. This is the exact pattern we've seen before every major market pullback of the last decade. The combination of record-high market concentration, historically stretched valuations, and now a potential global trade war is creating the perfect storm for investors. Let's be clear about what's happening. President Trump has just fired the opening shots in what could become the most consequential trade war in modern American history. Over the weekend, he ordered the imposition of a 25% tariff on Canadian and Mexican imports and a 10% levy on Chinese goods. These aren't small, targeted measures. They're broad taxes affecting America's three largest trading partners, which together account for over $1.5 trillion in annual trade. The market reaction was swift and brutal. Stocks immediately fell as investors grappled with the sudden reality that the campaign rhetoric about tariffs wasn't just talk, it was becoming policy. Even the last-minute reprieve for Mexico, which saw Trump delay implementation by 1 month after Mexican President Claudia Sheinbaum agreed to deploy military forces to the U.S.-Mexico border, wasn't enough to calm Wall Street's nerves. But why are markets so concerned about tariffs? Because history has taught us that trade wars have real economic consequences. To understand why tariffs matter so much to markets, we need to break down how they actually impact the economy. Contrary to popular belief, tariffs don't primarily hurt foreign companies, they hurt American businesses and consumers. When the U.S. imposes a tariff on imported goods, one of two things happens. Either American companies that rely on those imports see their costs rise, squeezing their profit margins, or they pass those higher costs on to consumers in the form of price increases. Neither outcome is good for the economy or the stock market. Goldman Sachs analysts who modeled the impact of these new tariffs estimate they could reduce the S&P 500's fair value by approximately 5%. As they explained in a note released Sunday, we estimate that every 5% point increase in the U.S. tariff rate would reduce S&P 500 EPS by roughly 1 to 2%. As a result, if sustained, the tariffs announced this weekend would reduce our S&P 500 EPS forecasts by roughly 2 to 3%. Bank of America's analysis is even more pessimistic, suggesting that a full-scale trade war between the U.S. and its largest trading partners could translate into an 8% hit to the S&P 500's aggregate earnings. For a market that's already priced for perfection, with valuations at historically high levels, this is a significant risk. Beyond the direct impact on corporate earnings, tariffs tend to strengthen the U.S. dollar. This creates another headwind for American companies because a stronger dollar makes U.S. exports more expensive in foreign markets and reduces the value of international sales when converted back to dollars. Given that international sales account for about 28% of the S&P 500's revenue, currency effects can meaningfully impact bottom lines. Another critical factor that makes today's market particularly vulnerable to tariff shocks is the unprecedented concentration of market capitalization in just a handful of stocks. This morning, the top 10 holdings of the S&P 500 represented 50% of the index's total market cap of $46 trillion, an historic high. This extreme concentration means that if these mega-cap technology companies are negatively impacted by tariffs, either directly through higher input costs or indirectly through reduced global growth, the entire market could suffer disproportionately. There's simply not enough breadth in today's market to withstand significant weaknesses in these few dominant names. Look at what happened today. Companies like Apple, which fell more than 3%, and Nike, which relies heavily on Chinese manufacturing, were among the hardest hit on the Dow. On the Nasdaq, Tesla and semiconductor companies saw steep declines as investors priced in the potential disruption to their global supply chains. Perhaps even more damaging than the direct economic impact of tariffs is the uncertainty they create. Markets hate uncertainty. And right now, the U.S. Economic Policy Uncertainty Index has spiked to levels not seen since the early days of the COVID-19 pandemic. According to Goldman Sachs, this level of uncertainty has historically translated to a 3% reduction in the S&P 500's forward P/E ratio. This means that even if earnings remain stable, which they likely won't under tariff pressure, stock valuations could compress simply due to increased risk premiums demanded by investors. Former J.P. Morgan chief strategist Marko Kolanovic captured this dynamic perfectly in a recent podcast recorded before Trump's tariff announcement. He warned that the combination of high market concentration, elevated stock valuations, and brewing political turmoil was setting the stage for a significant market correction this year, potentially sending the S&P 500 down more than 1,000 points from current levels. After the tariff announcement, Kolanovic noted, "Trade war puts us in a 2018 environment. Higher volatility, lower valuations. Those who point out that Trump cares about the stock market should remember that even then he did not react until approximately a 5% decline. Tolerances for declines could be higher now, and markets are at highs." This historical perspective is crucial. During Trump's first term, markets initially brushed off tariff threats, assuming they were merely negotiating tactics. But when the administration followed through with the actual tariffs, volatility spiked and stocks sold off sharply. Only when the Federal Reserve stepped in with rate cuts did the market stabilize. The market's reaction to tariffs isn't just theoretical. We've seen this movie before. Looking back at Trump's first term provides valuable insights into how markets might behave this time around. When Trump first began discussing tariffs in 2017, markets largely shrugged it off. During the build-up phase, when his administration investigated China's trade practices and considered potential actions, the S&P 500 continued its upward trajectory. The bullish trading cycle remained intact, with key moving averages trending positively. But everything changed once actual tariffs were implemented. Between January 22, 2018 and December 24, 2018, the S&P 500 lost 18% of its value, as the administration imposed tariffs on steel, aluminum, washing machines, and various Chinese goods. Each new tariff announced triggered market sell-offs, and each retaliatory measure from trade partners exacerbated the declines. Of course, tariffs weren't the only factor at play. The Federal Reserve was also aggressively raising interest rates during this period, hiking by 100 basis points over the year. This double whammy of trade tensions and monetary tightening created a perfect storm for markets. Interestingly, once the Fed pivoted at the end of 2018 and signaled it would stop raising rates, markets found a floor and rebounded dramatically. This suggests that while tariffs can certainly hurt market sentiment, their impact is magnified or mitigated by monetary policy. While tariffs affect the broader market, their impact isn't uniform across all sectors. Understanding which industries are most vulnerable and which might actually benefit is crucial for navigating the current environment. The hardest-hit sectors from today's market action provide clues about where the pain might be concentrated. Automotive companies, stocks like Tesla, General Motors, Ford, and international automakers with U.S. listings all saw significant declines. This makes sense given the complex global supply chains in the auto industry. Many American cars include parts manufactured in Mexico or Canada before final assembly in the U.S. A 25% tariff on those components would dramatically increase production costs. Technology hardware companies like Apple, which relies heavily on Chinese manufacturing, were among the biggest losers. Apple's exposure is particularly concerning given its outsized weight in major indexes. When Apple sneezes, the market catches a cold. Beyond Apple, semiconductor companies face significant risks since their supply chains are thoroughly globalized. Consumer goods, retailers, and consumer products companies that source heavily from China, Mexico, and Canada saw their shares tumble. Nike, which manufactures many of its products in China, was down sharply. Walmart and Target, which import billions in goods annually, also face pressure as investors worried about their ability to maintain margins if input costs rise. One often overlooked aspect of trade wars is their impact on currencies. Today, we saw significant movement in forex markets, with the US dollar strengthening against major trading partners' currencies. The dollar rose to a record high against China's yuan and sent the Canadian dollar plunging to its lowest level since 2003. This dollar strength is a direct consequence of tariff policy. When trade barriers go up, the currency of the country imposing those barriers tends to strengthen. A stronger dollar creates winners and losers in the market. Companies that generate most of their revenue domestically might benefit, while exporters and multinationals with significant international sales will feel pressure. For investors, currency-hedged ETFs like DBEF, Xtracker's MSCI EAFE Hedged Equity ETF could become increasingly important tools as currency volatility rises. Perhaps the most significant concern surrounding tariffs is their potential to fuel inflation. When the cost of imported goods rises, those increases often get passed on to consumers, pushing prices higher across the economy. This inflationary pressure creates a difficult situation for the Federal Reserve. On one hand, higher inflation might warrant a slower pace of interest rate cuts or even a pause in the easing cycle. On the other hand, if tariffs slow economic growth, the Fed might feel compelled to cut rates more aggressively to offset the damage. Oil prices have already started reacting to these dynamics, rising on news of the tariffs as traders analyze how levies on Canada and Mexico, the two biggest sources of oil imports to the U.S., will affect the energy market. Higher energy costs could further exacerbate inflation pressures throughout the economy. Before making drastic portfolio changes, it's worth considering an alternative view, that these tariff announcements are primarily negotiating tactics rather than final policy positions. Trump has frequently used tariff threats as leverage in trade negotiations, only to delay or modify implementation after extracting concessions from trade partners. We've already seen this pattern begin to play out with Mexico, where the tariffs were delayed by 1 month following agreements on border security. Similar negotiations are likely underway with Canada, as evidenced by Prime Minister Justin Trudeau's talks with Trump that led to a 30-day pause. This approach aligns with what Trump himself has called the art of the deal, starting with extreme positions to create negotiating leverage, then working toward more moderate outcomes. If this is indeed the strategy, we might see the most severe tariff proposals watered down over time, potentially limiting their economic impact. One final factor worth considering is how the current market structure might amplify volatility from tariff-related news. The historic concentration of market capitalization in just a handful of stocks creates a precarious situation where weakness in even 1 or 2 mega-cap names can drive significant index declines. This morning, the top 10 holdings of the S&P 500 represented a staggering 50% of the index's total market capitalization of $46 trillion. When half the market is concentrated in just 10 companies, diversification benefits are severely diminished. This concentration also means that passive index investors, who now represent a significant portion of market participants, are taking on far more single-stock risk than they might realize. Someone buying an S&P 500 index fund today is effectively making a massive bet on a small handful of technology companies. What do you think about Trump's tariff strategy? Share your thoughts in the comments below. And don't forget to subscribe to the channel for a more in-depth analysis of how policy changes affect your investments.